Welcome back. You're watching HFO-TV. HFO-TV is co-sponsored by the construction, repair, and restoration firm J.R. Johnson, the real estate law firm Baljanik LLP, the tax deferral accommodator Butler Exchange Group, the mortgage banking firm Gantry Incorporated, and forensic building consultants providing building structural science services.
Victor Calanog is head of commercial real estate economics at Moody Analytics. Before the Moody's acquisition, he led REIS economics and research team as a chief economist responsible for the vast majority of REIS's economic models. He is a managing editor of the Council of Real Estate Finance publication and serves on the board of directors at the Councils of Real Estate. He has an MBA in finance and an MA in business and public policy, all from the well-regarded Wharton School of the University of Pennsylvania. I want to thank Victor for taking the time to do this. I know last time we tried to get him out here last year and we had some issues on him getting out here, so we're doing this remotely. So Victor, take it away.
Thank you very much for having me, Greg, Aaron, and the rest of the HFO real estate investment folks. And thank you for the kind welcome. I hope you all had a great holiday break. What I'd like to do for the next 20 minutes or so, next slide, please, so that we could show the agenda, is to step back a bit and give you the national overview of macroeconomic trends, as well as some metro level updates for a handful of markets to situate the conversation about Portland, specifically given everything else that's going on. Then I'll provide an update on fourth quarter performance metrics where available and share our read about what's next for pricing and transaction markets. We'll go through light-tech markets or affordable housing, as you can see here in the second bullet, but also other forms of rentals like student housing, though the bulk of the discussion will be about market rate multifamily. Next slide, please. And with that, let's begin with an economic overview. Next slide, please. First, the economy. To give you some perspective, our national latest baseline forecasts show that the U.S. economy is likely to contract by between 2 to 2.4% for all of 2020. Now, I know that sounds like a small number, but for perspective, take note that the U.S. economy shrank by all of 3.8% in the Great Financial Crisis from December 2007 to June 2009. So 2020 is still going to be a pretty bad year, relatively speaking. The official numbers aren't out yet, but actually it's not as bad as we initially thought for a variety of reasons we will explore today. So back in March and April of 2020, we were projecting a 6.9% decline in US GDP, making it almost twice as bad as the Great Recession. That was then lowered to 6.2% by around June. Do take note that the IMF went the opposite way. They started at minus 5.2, and then they went to minus 8 by June. Well, fast forward to today, and at around late October, late November, US third quarter GDP numbers came in well above consensus. It's that big positive spike that you see in the middle of this chart. We are now only at around 3.5% off GDP levels versus the end of 2019. And we should have grown a bit in the fourth quarter, though it probably slowed down significantly versus what we recorded in the third. So bottom line, though the second quarter, as you can see here in this chart, in that big dip, it was simply devastating. We all knew that. It does look like the US economy overall is bouncing back faster than many people expected. And at least 7 to 8 months ago, it was really, really dire. Those forecasts for GDP change have been revised towards the more optimistic. We are still assuming, however, in our baseline scenario outlined here in green, I hope you could tell that given the colors of the slide, we're assuming that about $900 billion of stimulus will be deployed over the first quarter of this year. Is it going to be $600 or $2,000 stimulus checks? Still very much TBA, but there's some support in the works. Okay, we've talked about GDP change. We're done, right? Well, not exactly. So part of what makes this downturn so difficult to interpret is the fact that there have been countervailing forces that render any analysis that confines things to just high-level GDP change pretty much incomplete. For example, if you take a look at the record-breaking 32% or so annualized decline in US GDP in the second quarter, sure, it was followed by a record-breaking bounce back in the third, but the best estimate I've seen when it comes to the impact of fiscal support is that government spending actually added about 15 percentage points to GDP growth in that horrible second quarter. So what that means is without that record-breaking amount of fiscal spending that the US government provided, the annualized decline in the second quarter would have approached 50%. So think about that as we talk about how labor markets are being affected right now because, next slide, please. Sure, the overall economy is seemingly on a positive track. At least the forecasts are less negative. But that really doesn't mean that we're revising all of our forecasts from negative to positive. For one thing, labor markets have not been recovering as fast as, say, retail sales, which recovered its end 2019 numbers as far back as June or July of 2020, though the majority of the growth and recovery was captured by online retailers and not brick and mortar retailers. So if you take a look here at slide 5, we present the top markets for job loss projections, about 15 of them in percentage terms for calendar year 2020. Now, there's no need to squint. I've tried to provide a lot of data here in case you want to pour through the deck after our session. But right now, let me tease out the overall story for you, starting with the bottom row. First, the US as a whole is expected to lose about 6.1% of its employment base for calendar year 2020. So while other factors like retail sales have recovered, and while top-line GDP measures are quote-unquote only around 3% or so off end 2019 or pre-COVID levels, the labor markets are simply not healing as quickly. The biggest driver in overall job loss projections is, no surprise, the relative share of leisure and hospitality jobs in a geographic market. That's why I have those last two columns on the right as a comparison. So for the market that is expected to incur the most severe job losses for 2020, Flagstaff, Arizona, well, no surprise, over 15% of total jobs is in leisure and hospitality, a segment that is forecasted to decline for this geography by over 45% for calendar year 2020. That would be the top row. So the US as a whole has less than 10% of its jobs in leisure and hospitality. So that's dragged down quite a bit less than Flagstaff, Arizona, or, as we go down the list, Lake Charles, Louisiana, or Atlantic City, New Jersey. That's a couple of hours drive away from where I am right now. Well, what's the good news? And John Mitchell is going to lead us in a deeper dive here for Portland in a few minutes once I'm done. Guess what? Portland is not on this top 15 list, right? And neither does it appear to have any markets in either Oregon or Washington state. Moody's figure for Portland is a 6.9% decline in total employment. John, feel free to disagree later, at or around the national figure. And several MSAs in Oregon and Washington states have projected job declines of actually 3% or less. So now the official numbers will be out in a few weeks or so. So these are all estimates at this point. 2020 just got done a few days ago after all, but in general, the picture is relatively positive for the Portland/Oregon area. Next slide, please. So why focus on jobs so much? Well, we can talk about GDP all day long, but in multifamily and commercial real estate as a whole, with the possible exception of hotel, it's jobs that will be the more proximate driver of performance metrics to which we now turn. Next slide, please. So here in slide 7, we have the latest data for the multifamily market rate rental segment, the national figures of which are composed of Moody's top 79 largest markets, which do include Portland. In the fourth quarter of 2020, national vacancies rose by 10 basis points versus the prior quarter. It hit 5.2%. Year over year, vacancies have risen by 50 basis points, again, relative to end 2019, which we now fondly recall as those halcyon pre-COVID days. Asking and effective rents both declined by 1.4% in the fourth quarter, which is less severe than the third quarter, but for many apartment markets, the hits really do appear to be coming from the rent side. Occupancies seem to be relatively stable, but a lot of that is likely because of stay-at-home and or eviction moratoria policy, which has been extended in many places throughout early 2021. But make no mistake, the apartment market is taking some lumps, particularly on the rent side. Next slide, please. But let's take all that in perspective. I present specific numbers in the table on the upper right-hand side of the previous slide, but here what I do is to present a chart of construction, absorption, and vacancy, both for history through the early 1980s, as well as for the 5-year forecast period to the right of that green vertical line. I wanted to emphasize 2 key points. First, vacancies have really risen by a modest amount. Sure, it's at 5.2% right now, nationally speaking, but from a long run point of view, that is not high at all. In fact, depending on the length of time period that you specify, it's really only at or around the long run vacancy rate for the sector, which is between 5.2 to 5.4%. Conditions have simply been exceptionally tight for multifamily over the last 8 or so years. In fact, vacancies have not risen past 5% since the first quarter of 2012. Second point, from a forecasting point of view, therefore, we are really relatively sanguine, even as we project vacancies to go as high as 6.5% or so this year, 2021. That is nowhere near the 8% record high that we hit in early 2010. This is me being relatively optimistic, by the way. I know I'm an economist, so sometimes it's hard to tell. So even as we get through this relatively rough COVID-19 induced patch, let's keep things in perspective. As far as we can tell or project, multifamily is still likely to do relatively better than other property types, with a possible exception of warehouse distribution and logistics space in industrial, both in the short run as well as over the long run. Fundamentally speaking, even though we're in the middle of a pandemic, we are not projecting a major extinction event or a mass move out away from the US. Facetiousness aside, we are relatively bullish about the multifamily sector over the long run, despite some short-run bumps in the road. And those bumps in the road, let's not forget, are big indeed for places like New York that posted record rent declines for 2020. Next slide, please. Well, what about other housing types, like, say, student housing? Next slide, please. Thank you. Given all the uncertainties, here are the figures for fall 2019 to fall 2020 actuals. This bakes in September and October numbers. First, the good news, student housing operators were still able to eke out year-over-year gains in rents, 1.3 to 1.8% for the fall over fall time period, depending on properties that rented by the unit or by the bed. Now, that doesn't mean there was no distress. It was simply concentrated, unsurprisingly, on the occupancy side. Vacancies rose by 270 basis points for properties that rented by the bed, ending fall 2020 at 7.9%. That was also likely exacerbated by the fact that a good amount of inventory came online in the summer, with inventories increasing by 2.6%. By contrast, though not by much, vacancies for properties that rented by the unit increased by 120 basis points, ending fall 2020 at a still relatively tight 2.5%. There are some regional differences apparent in the chart on the right, with properties that rented by the unit taking more of a nosedive in terms of rent change in the Southwest. So we'll update and present forecasts for fall 2021 the following quarter, but of course, all of this is available to Moody's clients market by market. Suffice it is to say that we expect deterioration in performance metrics over the course of the academic year. We're in the middle of it already, as universities and many other institutions are just trying to figure out this new normal, given the spikes and troughs when it comes to COVID cases, especially when it comes to the basic question of how to deliver education as a service. Next slide, please. And here, what I'd like to do is end our discussion of rents and vacancies with a little bit of good news. The sector that's expected to hold up, affordable housing, is indeed holding steady. Vacancies were flat and tight in the third quarter at 2.4%. We don't expect that to change much in the fourth quarter. That's pretty impressive given everything that's going on. And then take a look at the rent growth patterns for the top 5 LIHTC markets on the chart on the right. Wow, talk about diverging performance vis-a-vis market rate rentals, which are represented by the light blue columns. LIHTC markets in Omaha, Washington, D.C., Tacoma, Albuquerque, and Lexington, they all eked out positive asking rent gains of anywhere from 0.1 to well over 1% for the third quarter, while for many geographies, you can see market rates tanking. Check out DC. That's that sharp light blue line going negative over there. Overall, asking rents fell at the national level in the third quarter by 1.8%. It was actually a record decline. It's more than twice the previous quarterly record decline of 0.7% in the fourth quarter of 2009. Well, guess what? Rents for LIHTC properties actually rose by 0.1%. So LIHTC asking rents have also been rising consistently every quarter throughout 2020. It was up by about 1% through the third quarter. With relatively low rent levels constrained by HUD median income guidelines, strong demand given the affordability crisis in this country, and economic distress magnified by lockdown policies, LIHTC property performance metrics are benefiting significantly, and really, they have yet to show any systematic signs of major distress. So next slide, please. Okay, so that's your backdrop on the overall economy and income drivers like rents and vacancies. What about transaction markets? Well, here, let's get a little bit more specific. Next slide, please. Overall transaction activity is down by anywhere from 50 to 60% or more year to date. That would depend on the property type. Third quarter transaction volume compared to the same time last year is down over 40%. We're still compiling fourth quarter numbers. Now, this is no longer a surprise given how uncertainty has frozen deal flow. Some good news, perhaps, transaction volume actually rose in the third quarter by approximately 10% relative to the second quarter. This actually roughly parallels what the Mortgage Bankers Association released in early November regarding third quarter origination volumes. It was down 47% relative to the third quarter of last year, but up around 12% versus the second quarter. These numbers might change on the margin as we finalize our fourth quarter numbers, but these general trends, I think, reflect a continued divergence in buyer and seller expectations. What do I mean? Next slide, please. So take a look at our pricing projections by sector represented by our Moody's Commercial Property Price Index. The peak to trough figures by business cycle are presented here in slide 13. You'll see that reflecting what I said earlier, we are relatively sanguine about the multifamily sector. We quote unquote only expect multifamily and warehouse distribution prices to fall by a modest 9 to 10% peak to trough, but office and retail should incur bigger haircuts at between 23 to over 30%. Also do take note, if you compare the middle row versus the bottom row, our projections for this downturn are actually milder than how the CPPI declined peak to trough during the great financial crisis. Well, if that's my attempt at being relatively optimistic, I think I'm kind of doing a pretty bad job compared to other measures of sentiment. For example, take a look at the next slide. The Pension Real Estate Association, or PREA, surveyed 21 firms through August and September, and in a report that they released just a couple of months ago, they noted that on average, these firms expected NCREIF's appreciation returns to decline by only 6.8% in 2020 and another 1.9% this year. Methodological point of note, appreciation returns do include negative capex. So if you want to convert it to price declines, you're going to want to lower that negative figure by about 200 bips. So here are 21 institutions suggesting that the total price decline might be only around 5%, peak to trough, whereas Moody's CPPI is suggesting that it would be several orders of magnitudes worse. So what gives? Well, number one, NCREIF usually covers institutional grade commercial properties, so you could make an argument that these are the better, higher quality properties that will weather the downturn better. I mean, after all, your properties are obviously better than everyone else's, right? Every property is above average, right? Now, I'm joking, but of course, but my second point is this is yet another measure of sentiment, right? So once again, we go back to, well, are there comps out there that we can point to? In a paper that I published with CW Capital's Dan Horsholak, they're a big special servicing firm, a couple of months ago, what we did was to investigate 161 appraisals dated from April 1 or later. That should remove any misattribution from pre-COVID events. Okay, reappraisals actually aren't transactions, though these were likely executed in preparation for a change of ownership. And what did we find? This is my last slide. Next slide, please. Unfortunately, the sample only includes hotel, retail, and mixed-use properties, but we found an average decline in appraised value of about 25%. Lower bounds are presented in one of the middle columns, and wow, you could see value declines of 50% or more. But, however, it's worthwhile to note that even for malls, you can see that in one of the rows over there, you can see that the upper bound has positive appraisal price changes. So sure, we can talk about averages all day long, but given the relatively idiosyncratic nature of each commercial property and deal, as usual, one will need to kick the tires and make a determination as to the true value of an asset given various considerations. I'm preaching to the choir here, so I won't belabor the point. I did want to share one interesting observation. Feedback from several broker clients is that there is a pretty good amount of equity investors out there looking for deals. What appears to be coming to market so far, however, are relatively low quality assets that probably would have traded on a discount even without COVID. So the higher quality assets probably are retaining their tenants and their income flow, and there's therefore less pressure to cut values or even sell. So I do think we're still in that interesting limbo where the bid-ask spread is still likely very wide. If you're a buyer, you're thinking it's the middle of a pandemic, I should be looking for discounts, I want a 30% haircut or more. If you're a seller with a high quality asset that's very desirable, you're probably thinking, why do I feel the need to discount my high quality assets if I don't need to sell today? And until we get over several humps of continuing uncertainty, expect transaction volume to be relatively constrained. Think one last point to note, multifamily cap rates, unless you've seen otherwise, and tell me if you have been relatively flat throughout 2020 and even declining in some markets. So we may well be in a situation where our pricing forecasts, which are based on deteriorating income side metrics like rents and vacancies, we might just get it dead wrong for the pricing side because low interest rates are just propping it up for some property types and areas. It may well be a situation where rents and vacancies are declining, but who cares? Pricing isn't changing at all.
Thank you, Victor. That was a great insight. And as I would agree, we are seeing in our market, cap rates have not deteriorated even in the middle of a pandemic. So the buy and ask, it is wider than we thought it was going to be. And again, I'm thankful that we are in multifamily because we've felt some of the pain, but it doesn't seem to be as great as we've seen in other areas and sectors of commercial real estate.
Our entire office specializes in multifamily real estate, making HFO the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information.